Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 4. This is Section E1. This is a remembering and understanding topic. Identify the factors, such as change in accounting principle, the correction of a material misstatement, or a material change in classification, that would affect the comparability or consistency of financial statements. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, in today's video, this is going to be another shorter video, so the YouTube version is going to be 5 questions, and the member version is going to be 5 questions as well, because this is a very small, simple topic. We're really just going to be talking about how change in accounting principle, correction of material misstatement, or a material change in classification affects comparability or consistency. There's not too much to it. But normally, SuperfastCPA Pro members get access to the full 10-question versions of these videos. So again, even though we're only doing 5 questions for this video, normally we do 10-question videos for the Pro members. So if you like the YouTube video and you like our other YouTube videos, make sure you check out becoming a SuperfastCPA Pro member, because you will get access to the full 10-question versions of the videos whenever we do 10-question versions, which is most of the time. And you'll get access to a lot of other great stuff, including the Pro course, where Nate explains in detail exactly how you're going to be passing the exam. It's kind of like a much more in-depth version of our 1-hour webinar. And speaking of that, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. If you check out that webinar, you will again learn in 1 hour for free the key ingredients to passing the CPA exam. And after you watch that, you're going to want to learn more. So you'll also want to check out becoming a Pro member, which I've already talked about. So make sure you check out the webinar, check out becoming a Pro member. And with all that, let's dive into this short video. All right, here we are at question 1, and I wanted to start off with something very simple just to make sure that you understand this. Which of the following best describes comparability in financial reporting? Now, you might think you understand this, but let's go through these options just to make sure. Option A, the consistent use of accounting estimates from period to period. Option B, the ability to compare an entity's financial information across different reporting periods or with other entities. Option C, presenting financial statements in accordance with a standard reporting format. Or option D, the application of the same accounting principles throughout the company. Now again, that's probably not too difficult, but I want to make sure that you understand what comparability is before we dive into how it's affected by the factors that we're going to talk about. So if you already know, that's great. If you want, maybe pause the video and think about this, and when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is B, the ability to compare an entity's financial information across different reporting periods or with other entities. Again, that's probably pretty easy to pick out because it literally says compare in the answer. So just want to make sure that you understand this. Comparability is a qualitative characteristic of financial reporting that allows users to identify similarities and differences between financial statements across different periods or entities. For example, if one company reclassifies interest expense from operating to financing, but another company does not, users will struggle to compare their cash flows. Comparability helps investors, lenders, and other stakeholders make meaningful decisions based on differences in performance or financial position. So again, making sure that different companies or different periods are comparable so that people can actually compare and see the differences is what comparability is. And again, we're going to talk about how that's affected by the 3 factors that I mentioned at the beginning. But first, I wanted to make sure you understood what comparability is. Now let's go to the next question. All right, here we are at question 2. Which of the following best illustrates the concept of consistency in financial reporting? So again, we understand what comparability is now. We need to understand what consistency is so that we can understand the factors that we're going to talk about. So let's go through the options. Option A, a company begins estimating uncollectible accounts using the aging method instead of a flat percentage. Option B, a company adopts a new accounting principle due to a recent FASB update. Option C, a company reclassifies certain expenses from general and administrative to cost of goods sold. Or option D, a company continues to apply the straight line method of depreciation each year for its delivery trucks or delivery vehicles. So again, what of these best illustrates the concept of consistency? Now, again, you probably understand that just by understanding the word consistency. So you probably already know the answer, but if not, that's okay. Go ahead and pause the video, think about this, and when you're ready, come back, we'll look at the answer together. All right, here we are at the answer D. A company continues to apply the straight line method of depreciation each year for its delivery vehicles. So let's go through this. Consistency refers to using the same accounting principles and methods from period to period within the same entity. This helps users evaluate trends and performance over time. For example, if a company uses the straight line method of depreciation on its vehicles 1 year and switches to accelerated depreciation the next year without a valid justification, it disrupts consistency. Changes like in options A and B may be justified, but still break consistency and require disclosure. So you can break consistency or ruin it, but as long as it's justified, you just have to disclose that, yeah, we know that this isn't going to be consistent across years because we had to change this because of a rule, or we were justified in making this change in accounting principle because, again, it's something we're allowed to do. That's the idea behind consistency, is having the same principles and methods applied period to period and year to year. And you have to kind of make sure that people know if you are changing those year to year so that they can see the consistency and know this isn't going to be consistent with last year. So again, we understand the concept of consistency now. Now let's go to the next question. All right, here we are at question 3. Now that we understand comparability and consistency, now we're going to start talking about the factors that affect those in the financial statements. So, which of the following best illustrates a change in accounting principle that affects the consistency of financial statements? Let's go through options. Option A, a company changes from expensing advertising costs when incurred to capitalizing and amortizing them over time. Option B, a company corrects a prior year error in inventory count that overstated cost of goods sold. Option C, a company reclassifies certain lease payments from financing to operating activities in the cash flow statement. And then option D, a company updates the useful life of its machinery from 10 to 12 years due to new maintenance data. So again, which one of these best illustrates a change in accounting principle and it's going to affect consistency? So we just learned about consistency and we have talked about accounting principles in previous videos. So you probably have a general idea of what a change in accounting principle is. If not, that's okay. But if you have an idea, pause the video, think about this, and come back when you're ready. All right, here we are at the answer. A, a company changes from expensing advertising costs when incurred to capitalizing and amortizing them over time. So this would be a change in accounting principle, and that would affect consistency. We did talk about a little bit about that in the previous question, so let's go through this. A change in accounting principle, such as capitalizing advertising costs instead of expensing them, disrupts consistency and must be disclosed. ASC 250, which by the way, you probably don't really need to know that, but I just wanted to throw it in there, requires retrospective application, if practicable, to preserve comparability across periods. And the auditor ordinarily adds an emphasis of matter paragraph to highlight the change. And we talked about emphasis of matter paragraphs a few videos ago. If retrospective application is not feasible, comparability is also impaired when comparing across time or with entities that follow a different policy. So again, this definitely affects consistency, but it's possible to affect comparability if you can't retrospectively apply this change. So a change in accounting principle requires a retrospective change, and if for some reason that's not feasible, then it can also affect comparability, but it definitely affects consistency when you have a change in accounting principle. Now with that, let's go to the next question. All right, here we are at question 4. Which of the following most clearly represents a correction of a material misstatement that affects the consistency of financial statements? Okay, let's go through the options. Option A, a company begins using FIFO instead of weighted average inventory costing. Option B, a company reclassifies software development costs from R&D expense to intangible assets. Option C, a company discovers it overstated revenue last year due to premature revenue recognition and corrects it in the current year. Or option D, a company decides to start using the straight line method of depreciation for new equipment acquisitions. So again, which one of these clearly represents a correction of a material misstatement? Probably not too hard to figure out the correct answer, but if you want, pause the video, think about this, and when you're ready, come back, we'll look at the answer together. All right, here we are at the answer. C, a company discovers it overstated revenue last year due to premature revenue recognition and corrects it in the current year. Again, that makes sense that it would be a correction of material misstatement, but let's talk about how that affects consistency or comparability. A correction of a material misstatement fixes errors from prior periods that were significant enough to influence users' decisions, such as prematurely recognized revenue. The correction is applied retrospectively, disclosure is required, and consistency is restored for future comparisons. So this affects consistency in the opposite way. With question 3, it was affecting consistency in a way that made things inconsistent and people would have to know about it. But in this case, it's actually making it so that consistency is restored so that you can compare stuff because it's been fixed and it shows the correct way. The other options involve voluntary changes in principle, and that was options A and D, or a classification, a voluntary change in classification, and that was option B, not misstatements. So again, that's why a correction of a material misstatement affects consistency. It affects it by restoring consistency because now, retrospectively, things are correct, so you can have the consistency between periods. Now with that, let's go to the next question. All right, here we are at question 5. Which of the following best represents a material change in classification that affects comparability and, unless prior periods are restated, also affects consistency? So let's go through the options. Option A, a company changes from LIFO to FIFO for inventory valuation. Option B, a company reclassifies certain selling expenses as cost of goods sold in the income statement. Option C, a company corrects a prior year error in overstated prepaid insurance. Or option D, a company adopts a new method of depreciation in all fixed assets. So again, which one of them represents a material change in classification that affects comparability? And if you think about it, it could also affect consistency if the prior periods are not restated. So based on what we've learned so far, you might have an idea, and you might have an idea just based on it saying material change in classification. But besides that, pause the video, think about that, and when you're ready, come back, we'll look at the answer together. All right, here we are at the answer. B, a company reclassifies certain selling expenses as cost of goods sold in the income statement. So let's go through this explanation. A material change in classification moves amounts between line items, such as reclassifying selling expenses to cost of goods sold. Because the underlying accounting principle is unchanged, the primary impact is on presentation. Comparability is affected, and consistency is also affected unless prior period statements are retrospectively adjusted. ASC 250, again, you don't really need to know that, requires disclosure and, if material, restatement of earlier periods. Option A is a change in principle, C is a misstatement correction, and D is a change in principle affecting depreciation. So again, a material change in classification will most likely affect comparability, and it could affect consistency unless the prior period statements are retrospectively adjusted. So we learned a lot about comparability and consistency and some of the factors that would affect those in the financial statements in this video. Before we do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 or 4 questions trying to teach you about how a material change in classification is going to affect the comparability or the consistency of the financial statements or whatever you see in the questions. Again, you are noticing these things pop up and you write them out in your own words, again, kind of as the most important things you learn from the questions, the pillar topics. And as you're doing this each day, you are building your own personal repository of the most important things that you learned from the questions, and you're writing it out in your own words so that you are ready for the exam. Now let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. First off, comparability. Comparability allows users to identify similarities and differences between financial statements across periods or between entities. It is often impaired by classification changes or differing accounting policies. Now let's talk about consistency. Consistency means applying the same accounting policies from period to period within the same entity. Changes in principle or corrections of misstatements break consistency and require disclosure. Now let's talk about the factors that we were supposed to talk about in this video. Again, first, change in principle. Switching accounting principles, such as, switching from FIFO to LIFO, usually requires retrospective application and an auditor's emphasis of matter paragraph. Changes in depreciation method are accounted for prospectively because they are treated as changes in estimate affected by a change in principle. So technically, changes in depreciation method are a change in estimate, but you do it by a change in principle, but it's applied prospectively. But usually a change in accounting principle requires a retrospective application and an emphasis of matter paragraph, and that is going to affect consistency and potentially comparability. Now let's talk about correction of misstatement. Correcting a material misstatement, such as fixing premature revenue recognition, involves retrospective adjustment and disclosure because prior statements were misstated. Now let's talk about classification change. Moving amounts between statement categories, such as reclassifying expenses, affects comparability and, unless restated, consistency, since presentation differs while the underlying method remains unchanged. So again, we learned about comparability and consistency in this video, and we learned about the factors that you basically need to know that are going to affect that: change in principle, correction of a misstatement, or a classification change. Now, with all that, we went over a lot in this video, and we're only doing 5 questions for the YouTube version and for the member version. But remember, SuperfastCPA Pro members typically get 10-question versions of these videos so that they can get a little bit more help and a little bit more understanding. This was just a short video because, again, this is a fairly straightforward topic. We just needed to know those factors and know what comparability and consistency are. But again, if you like this, make sure to check out becoming a SuperfastCPA Pro member. And the easiest way to do that is by actually going to SuperfastCPA.com and signing up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam, and again, it's free. And after you watch that, you're going to want to learn more, and you'll want to check out becoming a pro member. So check out the webinar, check out becoming a pro member. I hope this video was helpful. If you did find it helpful and you liked it, make sure to like it and leave a comment, and I will see you in the next video.